Welcome to Pique Your Interest, your go-to podcast for all things mortgage and real estate. Hosted by Tanner Greenwald and Tim Velasquez. We bring you expert insights to help you buy, sell, and invest with confidence. Let's dive in.
Welcome back to the podcast. I am Tim.
I am Tanner.
And we are here today to talk about the birth of mortgage interest rates. It's a really exciting topic.
I think so.
I think it's kind of cool. I mean, there's a lot of unique things about this that, I didn't know before I started this. I'm sure a lot of people don't know. And
I didn't know it either.
So let's go over it. So for starters, the word mortgage it's a mashup of words, sort of a portmanteau, I think is the word for it. It's a mashup of French and Latin. It means a life or death pledge. And so you're pledging that you will pay this back throughout the course of whatever your life may be. The first known use of it started like 2,500 years ago in Mesopotamia, in the 5th century BC. And clay tablets were used to record, who owed what to who and whose land belonged to who and things like that. And it sort of translated into like ancient Egypt, where these pledges were like the concept of, hey, I'm going to own this property, or I'm giving you this property. You're going to make payments on it until you own it or until you die, whatever the case is. It's sort of like one of the earliest forms of like banking that we have in history. So, you pledge to make these payments over the course of however long it is. Eventually one day, maybe you get to own that piece of property. And then mortgages really sort of changed from, clay tablets and little pieces of land to, in like 17th century England, more like what we are used to, where there's like a formalized system, written on paper and things like that. So a little bit more what we're used to seeing as far as a mortgage goes. I mean, mortgages have changed an awful lot since back then, obviously, but I think even in let's say like the 1900s, for instance, that's when mortgages really, really changed. And, certainly the 1930s were a really big decade for that.
Oh, yeah. Yeah. Should we talk about the 30s?
Let's talk about the 30s. Go for it.
Okay. So, we're used to a 30-year loan in this day and age.
Yep.
But in the 30s, that wasn't really a thing. So typically loans were like 5 to 10-year terms, which is weird to think about now, but that's, I guess, how they were.
Yeah.
And they were interest only, so balloon loan types were pretty popular then. And if you're not familiar with what a balloon loan is, it's basically a loan that you're taking out, but you're paying interest on it for however many months you're paying interest on it, 5 to 10 year terms. And then you have this lump sum due at the end of your term, which was hard for some people because, you're expected to pay whatever's due, and that might be a lot of money. So some people didn't have that money when their balloon payment was due. So risky, I would say.
Yep, sure.
Typically, the down payment in the 30s was anywhere from like 40 to 50% as well, which is weird to think about. So if you bought like a $5,000 house, your down payment was at least $2,500,
right.
Which, nowadays, thinking if people needed to provide 50% down, that's a lot of money.
Oh, it would be impossible.
Especially in Maryland. Yeah. So, and the reason that they had clients put more money down was, it was risky for lenders back then because the government wasn't necessarily insured. So if somebody defaulted on a loan,
Yep.
That is the lender's responsibility to pick that up. And, lenders didn't really want to do that back then. So
No, not at all.
They required a higher down payment type of thing. All of this in the 1930s, that was kind of the decade of the Great Depression. So unemployment was super high. People were having a hard time paying their bills. All of this led to basically creating the 30-year fixed loan.
Correct.
I would say. Yeah.
Correct.
In 1934, FHA was created. So that was basically the blueprint for our mortgage system now, which is pretty cool. I didn't know that FHA was created in the 30s. I had no idea.
Like in the next decade, we're going to be celebrating 100 years of FHA.
Right? Yeah.
That's nuts.
So this replaced the 5 to 10 year loan term with 30-year fixed mortgages, which was super helpful for people because it allowed them to be able to afford housing. They had a fixed monthly payment each month, and there wasn't some type of huge balloon that they had to pay off at the end of their term. So to me, it was FHA being created was pretty historical.
Yeah, no, absolutely. And, Fannie and Freddie came around that time too. Mm-hmm. That was kind of a big deal. you really can't overstate the importance of having FHA created, Fannie Mae, Freddie Mac created, because this allowed for things like, mortgage insurance, the development of the secondary market where, loans are, bundled up and backed by the government. And so there's a lot more safety in lending that way. And it made lenders feel better about issuing mortgages. And so you see things like down payments decrease. You no longer needed 30 to 50% of whatever the purchase price was to be able to afford a house. You could make a smaller down payment and then just make monthly payments over the course of a longer period of time, not just 5 or 10 years, but the 30-year fixed became a thing, a 15-year fixed. Yeah. You really can't overstate how important it was to have Fannie and Freddie. And there was a lot happened in like the 40s, 50s, 60s, and even the 70s as far as mortgage rates go. But rates were kind of up and down. That's just what rates do. Rates go up and rates go down. But the 1980s was a very tumultuous decade for interest rates. There was massive inflation in the 70s, massive inflation. And Paul Volcker's Fed in the 1980s was tasked with fighting this inflation. And, what we've seen recently in our own history is one of the ways that you really tame inflation is you raise rates. You just raise rates to the points that consumption stops and prices start going down again. And in real life right now, that's kind of where we are. Like we're seeing rates go down. As of Friday of last week, we got a report that, the Federal Reserve wants to maintain inflation at 2%. It's at 2.1. So we are awfully, awfully close to where we want to be with that. But that was not the case in the 1980s. It was massive inflation. And so Paul Volcker's Fed kept raising rates and raising rates and raising rates. And in fact, there was a period from 1979 to 1985 where interest rates were not below 10% at any point during that 6-year span. Yeah. That is crazy. I mean, we'd probably cry if rates were at 10% today. Yeah. Yeah. And in fact, in 1981, interest rates hit an all-time high of 18.625%. Which is like, holy crap. I'll say that again. That's 18.625%. Historically, we are still less than half of what that was back then. But 1981, terrible year for mortgage interest rates. So the 80s, having these high interest rates for 15 and 30-year fixed rates created ARMs, adjustable rate mortgages. And the thing that people really liked about adjustable rate mortgages is traditionally the way that ARMs have been priced is that you have an introductory period at a lower than market interest rate. And so if you have, let's just say a 5-year ARM, you have a fixed interest rate that's lower than what the market is for the next 5 years. That's locked in for 5 years. After that, your rate has the ability to go up or down based on where the market is. But the idea was, hey, if I could get in at 14% instead of 18.625, I'm coming out ahead, so I will take that adjustable rate mortgage. And so the idea of an adjustable rate mortgage became a thing in the 80s, and it's a very prevalent idea today. Like I still have clients call and say, hey, do we do ARMs anymore? Are there, is there pricing for ARMs? And the truth is, like, ARMs just aren't priced very well now, because I think the overall thinking is that in the short term we're going to see rates come down a little bit. Right. And banks don't really want to issue you a mortgage at whatever the rate is, and 5 years from now have to adjust it downward. They don't want to make less interest over time. Yeah. So the idea of ARMs, super huge in the 80s, not as big now. Things like assumable mortgages became bigger as rates started to come down later in the 80s. That was a big deal. We've seen assumptions come back now. After the last 4 years, we've seen rates rising. Anyone that got a mortgage 5 years ago has a terrific interest rate, and if they're looking to sell their house and they have the right type of mortgage, the person who purchases that house from them might be able to just take over that mortgage that they have, which is pretty sweet. So the 1980s were a pretty tumultuous time, right? As far as interest rates go, at the end of that decade, we see rates start coming down a little bit. Leading into the 90s, and I'll let Tanner take it away with the 90s.
Yeah, so the 90s is my favorite era because I was born in the 90s. So I remember a lot that went on kind of in the 90s. But one of the things that I remember is technology. Like, technology was massive, in my opinion. So many different things were coming out. Just in the world in general, computers were big then at that point. Yeah. But for
the birth of the internet.
Exactly.
That little thing.
Yeah, which is massive. But to to kind of put it in terms of how that helped the mortgage industry and interest rates and whatnot. So automated underwriting systems were introduced in the mortgage industry in the 90s, and that basically allowed for, quicker turn times to get loans approved, being able to kind of see what we were working with borrowers, whereas back in the day you had to like go through certain stages and there was no automated underwriting system, so it was a little bit harder. FICO score integration. So, we base our credit system off of a mortgage FICO score, which is different than the consumer FICO score. That's why sometimes when you pull your Credit Karma score, you see something totally different than what we're pulling from. But this integration basically allowed us as lenders to assess risk better, which was super helpful. And the internet, like Tim had said. So the internet allowed for like mortgage calculators to be introduced. Now they was very standard. It's not like the mortgage calculators I feel like you'd see nowadays.
Oh, gosh, no.
Yeah. There's online rate quotes. It just allowed for a lot of research to be done for mortgage lenders, for buyers, for just everybody that was looking to purchase a home at the time. So the technological advances that took place were, I think, pretty cool, in my opinion. Yeah. So as Tim had mentioned, in the 80s, the rates were like topping at the 18% mark. In the 90s, they were anywhere from like 7 to 10%. And again, it just depended on a couple different factors. But the focus was basically low inflation and economic growth from the 80s into the 90s. So the interest rates were knocked down a little bit because of that. Obviously, you can assume that refinances were pretty big in the 90s based off of people who bought in the 80s. They were wanting to get rid of that 18% interest rate to drop down to 7 and 10%. And it's kind of funny. Like people nowadays, they're like, gosh, interest rates are so high at 6 and 7%, whatever they are. And it's like, I always, in the back of my head, hear my parents saying, well, I had a 10% interest rate. Like, try that, for a mortgage payment. But anyway, so the 1990s had one of the longest economic expansions in the U.S. history. So unemployment rates dropped, the stocks were booming. So the 90s was definitely great for the economy for a number of reasons. But then it kind of takes us into more of the modern era, which is like the 2000s.
Yeah, and so like Tanner is really excited by the 90s. I'm really excited by the early 2000s. Not because I was born in the early 2000s, because I certainly wasn't, but I was in the mortgage business then. I started in 2003. So I kind of, what we talk about from this point moving forward, I've actually lived through. I've experienced, personally and professionally. So, in the early 2000s, there were some government initiatives. Everyone should be a homeowner. Let's get people into houses. Let's build as many houses as we can. Let's sell as many mortgages as we can. And so, from that, sort of off the wall, non-traditional products are born. So things like, you've probably heard of all of these things before, but like no-doc loans or stated income, stated asset, or interest only, those sorts of loans that we sort of look at now as really risky loans because, a no-doc loan is just like what it sounds like. There's no documentation. You don't collect pay stubs. You don't collect W-2s. You don't collect bank statements. You don't need to do that. If someone had a good enough credit score, they were deemed honest enough that if they told you, hey, I make, $5,000 a month, you just took their word for it. Mm-hmm. And this just, it's crazy to believe that we were in a period like that and that actually happened. But I mean, there were entire years where those types of loans just dominated the financial mortgage landscape. That's just the kinds of loans that a lot of people did. I didn't really do that many of those. I was still pretty new in my career when that happened, but I certainly know a lot of people that did a lot of, stated income, stated asset, or no docs, or, interest only, or, there was even a loan called a negative amortization where you would some people call it the pick a payment loan. You were given options to pay. You could pay just the interest for that month if you wanted to. You could pay the full principal and interest. You could pay extra, or you even had this crazy feature where you didn't have to pay all of the interest. You could just pay some of it, and then the rest of the interest was tacked onto your payment the next month, and you could keep deferring that interest. So it was called negative amortization because you were never really paying down the balance or even the interest for that matter. And so as you can imagine, that leads to problems because if you're not documenting people's income and you're just taking their word for it and they don't have to make full payments on their mortgage, if you give people the choice of, you can pay a little bit or a lot of it, a lot of people are going to pay a little bit. And so that leads to problems later on down the line because, all of these loans were packaged into mortgage-backed securities and they were sold to investors. And you could make the argument that investors, and it's probably accurate, that investors just didn't know how risky these loans were. You were bundling loans that were no doc with loans that were full documentation. Right. They had similar credit scores, similar down payments. So all the loans were sort of bundled together. And that's just, that was the standard operating procedure. You just did that. Right. And so, a lot of these loans like interest-only ARMs and negative amortization, at some point those payments come due. Like the bill always comes due, right? Like that just, it always is the case. So when the bill comes due and you all of a sudden can't handle the fully, amortized payment, or you can't handle, now you've got to pay not just the interest only, but you've got to pay everything. You've got to pay the principal back too. A lot of people couldn't handle doing that. And so you start seeing defaults on loans and massive waves of foreclosures. And so a lot of these investors are left holding, a bag full of money, but nobody's making payments on it at all. And so you just see this massive wave of foreclosures, people losing their homes. As a result, it affects the entire economy and people start losing their jobs. And even the people that could make payments before aren't able to make payments now because they've lost their job. And so you just have this entire crash from 2008 where these, interest-only ARMs, these no-doc, these stated income, stated asset loans just stop performing. And you get this massive wave of foreclosures. You even have banks and financial institutions that just completely shut down. I look some of these up, you might even remember some of these names in the news, like the Lehman Brothers went under in 2008. They were around for 158 years. 158 years they were around for. They were a financial institution that was highly respected, and they could not survive this crash. You saw companies like Bear Stearns and Washington Mutual, and actually Washington Mutual at the time was the largest bank failure in the history of the United States, which was pretty wild. And then we have, personal stories from a lot of people here at our branch that worked at National City, which at the time I think was like the 6th or 7th largest bank in the country. They went belly up, and there was an entire period where the government was enticing some lending institutions to bail out others. And so, that, from my personal experience, National City was bailed out by PNC, and, we worked for PNC for a short bit too. But yeah, really crazy, as crazy as the 80s were for interest rates, the 2000s were just wild for the crash that we saw. Things started to normalize after that. It took a while to recover. It took 5 years before business really picked back up. And then we sort of cruised through the mid 2010s into the late 2010s. And then 2020 hit and all hell broke loose. Yeah.
Well, before we talk about 2020, I know you were talking about the early 2000s from a loan officer perspective, because you obviously were the loan officer, but my mom had worked with Tim as well. So I don't even know how old I was. I was 13 maybe.
Yeah, that's
maybe 11 to 13, whatever age I was. But I remember it from that age group and how drastic it was for you all, just to kind of see, my mom was freaking out about the job a little bit, so I can only imagine you were as well. Yep. So it shifted, it shifted it from even a early teens perspective, if that makes sense, which I think is that's major.
No, I think there are a lot of people that are of home buying age now that would never entertain the idea of an interest-only ARM or, a no-doc loan.
Right.
These things are starting to make a comeback, by the way. These are loans that you can do, not through traditional mortgage companies like us, but, there are brokers out there that are doing these types of loans, and there are a lot more guardrails in place now than there were before, so it's a much safer product, if it can be considered safer. Right. But there are an entire generation of people that are of home buying age that would not touch those with a 10-foot pole, because they saw what happened to either their parents or a family friend, or just the tens of thousands of people that it impacted. Everybody knows somebody that was impacted by it.
Yeah, and even being a lender now, it's looking back, I can't even imagine that was even real, real life. You know what I mean? I can't believe that they would give somebody a loan without collecting documents, and just taking their word for it. Very, very weird. But it was history. So
yeah, it really happened.
To kind of jump into COVID, we all remember COVID.
Yeah.
COVID, good old COVID. So, you know, the uncommon time of COVID, which it really was very uncommon, it led to basically the Feds cutting the interest rate in March of 2020. Yeah. They were 3% and lower. You know, some of them, like I know some people who ended up with 1-point-something%.
Yep, exactly.
So with that, obviously, people who had purchased before 2020, they're looking to refinance. They want that low interest rate. They're looking to refinance their home. It just created a very frenzified, did I just make up that word? Frenzied home buying market. People wanted to refinance, but it was like everybody all at once. And I also remember this time frame. I was working on a team, but I definitely remember the hustle and bustle that came with that.
Oh, yeah.
So the drop in interest rates had everybody freaking out. Everybody was offering on homes. Some people were offering $30,000, $40,000, $50,000, $60,000 over asking price. They were foregoing home inspections. Like, what else am I missing? I feel like there was so much going on during the COVID timeframe.
Oh yeah, I mean, there was nothing that some people would not do to be able to buy a house. And it's, you have the ability to work remotely or whatever the case is. So like, you're not tied to a certain area anymore. So you could go do whatever it is you've always wanted to do or live wherever you wanted to live if you were the kind of person that had a remote job. And so the market just became uber competitive in a way that we've never seen before.
Yeah, and buyers obviously were jumping on any home that they could find on the market, and it became a point where there was nothing left on the market for people to purchase. Sellers were like, oh, well, if people are offering $50,000, $60,000 over asking price, I'm just going to put my house on the market. So it was just all over the place. Very crazy times. Yeah. But in 2022, inflation was at the highest level that it's been in decades. Just to kind of give you some numbers here, the Feds had to raise the interest rates due to the inflation that was going on. So in 10 months, mortgage rates jumped from 3% to 7%, which is the sharpest climb in decades.
Oh yeah.
Yeah. So, and I also kind of remember that as well. This created a lot of stress for buyers, for lenders, but people started freaking out because there were some people who were holding off on purchasing because they were like, we're going to let more homes get on the market where the rates aren't going to increase that much that soon.
Right.
So, and they did. So people started freaking out. They're like, crap, I didn't purchase at that time frame. Now I got to look into doing it, or now I'm going to hold off even longer. It just, the mindset of the typical buyer went pretty crazy. I had phone calls with multiple people trying to walk them through scenarios and the whole don't wait stories and whatnot.
Yeah.
So yeah, it was very stressful times. A lot of homeowners feel the ones that purchased from like 2020 to 2022, they now feel stuck in the mortgage that they're in. And I still face this with some clients I talk to nowadays. They have a 2% rate, a 3% rate, and they see the interest rates that have, been what they've been pretty much since 2022. Yeah. And they feel like they're handcuffed to the house that they're in now. They don't want to get rid of that mortgage because they don't want to get rid of that interest rate that comes with it. So that's another conversation that we have to have with buyers. It's just the way of what had happened and what we're at now type of thing. So the pandemic definitely created a perfect storm of sorts, and it definitely showed in our industry,
Yeah.
So
no, it's definitely tough. I mean, there are all kinds of stats out there. There's like 90% of all people that have a mortgage have an interest rate of 5% or less. And that is, historically speaking, an unbelievably low interest rate. I mean, we've talked about rates being between 7 and 10% for a long time in the 90s. We've talked about interest rates being not below 10% in the early 80s. And it's sometimes it's hard to sit back and hear people talk about how high interest rates are now. But compared to what we saw over the last 5 years, I mean, if you think about it, 5 years ago, I mean, we're right now as we're recording this, it's June 2025. So we're a little over 5 years into, that COVID period. And so 5 years ago, interest rates were darn near 2%. And now we're sitting at like 7-ish, right? That's a huge jump for people. And so there's a lock-in effect, like Tanner said. People don't want to sell their house. And we have an inventory problem. There's not enough houses for people to buy. Part of that is because people feel like they are going to keep that house. Like, I might not like the house that I'm in, but I've got a 2% interest rate, so I'm going to stay there for a while.
Right.
And if I do decide I'm going to buy something else, I'm probably not selling that house. I'm probably holding on to it and turning it into a rental property because I'll never own anything at 2% ever again.
Yeah.
So we just have this like lock-in effect that has frozen people in place, which prevents houses from coming on the market, which leads to buyers out there fighting for, a lot of buyers fighting for a few houses. Housing prices keep increasing because, if I want a house and Tanner wants a house and, I offer whatever the listing price is, she offers more than the list price. If I don't get a chance to counter that, she's going to buy that house at that higher than list price. And if I do get a chance to counter that, I'm going even higher than that. So we're in this cycle, right? Like we're just,
it's like, I think they call it the golden handcuff effect. I think that's what they call it nowadays.
Yeah.
So,
yeah, it's a really unique time that they're all unique times, right? Everything's so different, but one of the things that we've learned is that rates are recurring, right? Like it's like we just said, it's cyclical.
Right.
Interest rates are going to go up, interest rates are going to come down, they'll level out for a little while, they'll go up, they'll go down. The economy plays a part in what that looks like. Economic policies matter. We're dealing with tariffs now and what's that doing for interest rates. But the idea that rates are cyclical and that markets are cyclical and will come back around, eventually I know interest rates are going to be lower than where they are now.
Well, based on what we've even just talked about, the history of them, you can see based on what we were saying that they've gone up, they've gone down, they've gone up, and it's all based on an economic impact.
Yeah. No, there's definitely an economic impact, but there's also, one of the things Tanner really likes to talk about is she really likes to talk about the psychological impact of things.
I do. That I do.
But no, like this is definitely one of those cases. Like we are in a market where, I don't know how much we had to worry about like the trying to think of the right words, but like the psychological impact of interest rates lowering.
Right.
That was more of a greed thing. Mm-hmm. I want to get the lowest rate possible, and everybody always wants to get the lowest rate possible. But we went through this period in like 2020, 21, and even like the first half of 2022, we'll call it, where there wasn't a lot of psychology involved in this.
Very quick.
Yeah, it was very quick transactions. You just made an offer that was a lot more than what the seller wanted, and you probably got your offer accepted, and you got a super low interest rate, and you were really happy.
Right.
That's not the case anymore.
No, not even close. Yeah. So the psychological impact, obviously, it's more important, I think, now, and it's showing in the industry more now than it really ever has been. I think a little bit before 2022, and even 2022 until present point that we're at now, people have definitely thought about how they feel more about buying a home, how they feel more about the monthly payment that they have to make, how they feel more about offering on homes that have gone up in price, in value and whatnot. So it's psyching people out a little bit, and I don't think people are used to that because that's in this industry, the home buying industry, that's never really been considered or a thing. Lenders have had to put on their psychology hats, and if you don't have one, you got to learn how to have one at this point, And it's not just buyers, it's our partners that we work with as well. They're looking for answers, they're looking for guidance. So I think just having a little bit of information and knowledge about psychology in home buying helps you very much so, as a buyer, as a lender, as a realtor, as a title person, whatever the case is. But I'm seeing it personally more, and I know.
I definitely am. I think that it's a lot of. It's managing a lot of things. It's managing like the expectations that people have as far as like what it's going to be like to buy a house. Because if you're a first time buyer, you've never experienced anything like this before, that's one group of people that we would sort of cater a different way of approaching. Then there are people that have bought a house before and maybe it's been a while since they bought, but there's definitely a psychology involved in buying now versus buying then. You used to buy houses just because you needed to buy a house or you really liked a house. Now it's more, I think it's more intentional for people. It
kind of has to be.
Yeah, if you're going to be buying a house that is, by the way, like 40% more expensive than it was 5 years ago, and interest rates that have more than doubled since 5 years ago, the idea of having to think through these things before you really step into it has come to the forefront because everything is so much more expensive, up front and monthly. it requires a lot more thinking on people's part. I think people burn out easier now because of it, because it's so mentally taxing all the time. You know, it's an all-encompassing thing. When you're buying a house, it's, you know, there, like we said before, there's not a lot of houses on the market. So if you are in the market to buy a house and you see a house that you really like, you almost have to act immediately. And that's an incredible burden to bear. Thinking, I need to make a decision about, you know, I want to spend this much money. I want to pay this much money each month. This is where I want to live. This is how it affects like my commute or schools or whatever it is. And you've got to make that decision like that. You know, it's not just I looked at a house. I think I like it. I'll sleep on it. Maybe if there's an open house this weekend, I'll go take a look at it. Or if it's still on the market in 2 weeks, I'll reconsider writing an offer. It isn't like that anymore. No. I mean, there are definitely some houses that sit, but for the most part, good houses sell very quickly. You need to be ready to act. And I think the pressure of all of that, I think some people crumble under that pressure. And I think we've had to adapt to that line of thinking. You know, it's not just a financial transaction. There's a wide array of emotions involved too.
I feel like you almost have to have a good psychological strategy when you're buying a home at this point, because there's different things that attribute to you purchasing a home. So, you know, there's market trends. You can follow those. If you feel burned out, you can take a break. You don't have to unless you're like renting somewhere and you're getting kicked out type of thing. But like to have a good psychological mindset, it shifts the way that your strategy is going to be to buy a home, if that makes sense.
Totally does.
Yeah, it leads to less burnout, but it also leads to you being knowledgeable about your finances, being knowledgeable about the industry, and knowledge is power, you know? So, yeah, but that's the history that we have for, you know, interest rates, which again, I found super interesting. And I think I'm going to think you did too.
I'm hoping that we took what is probably considered a really boring topic and made it slightly interesting for people out there.
Yeah. But I also think it allows people to see, you know, that just because rates are sitting at like 6 or 7% right now, it's not the end of the world. This has happened before. Yeah. They probably will go down at some point again. They'll probably go up at some point again. You just have to almost go with the wave of how the market is.
Correct.
Yeah.
Correct.
So hopefully this has been helpful to somebody.
Yeah, that's always the goal. Always educating, always being helpful.
Yeah, agreed.
All right. Well, thanks for joining us. We'll see you next time.
Bye.
Bye.